here we go. As you look at this chart, quick preview here. Susan Sanders starts a business called Sanders Stitching. I'm just making this up, in which she repairs clothing. Complete her accounting based on the transactions she shared with you. These transactions will add accounts payable and accounts receivable, as well as ask you to further define how owner's equity was affected. So what I want you to notice first before we start is that the assets are here. The chart looks a little different, but it's same idea. You have cash, you have supplies, you have insurance. And then there's a new one that we haven't covered, and that's why I keep saying it's so important to be here today. This one is called Accounts Receivable Bowman Company. Okay, and then over here, this one's called Accounts Payable Maxwell Company. So one's accounts payable and one's accounts receivable. Here's just a brief intro, and we'll get to this later too. But accounts receivable means that someone buys something from you, but they haven't paid you yet. So that's an asset. When someone owes you money, that's a good thing. Okay, the downside is they bought something from you, but you haven't been paid yet. So there's always that chance that they could stiff you. That, hey, I did this for you a month ago, where's my money? And that happens a lot. But that's accounts receivable, that's what that means. Accounts payable is really no different than what we've been doing. It means you owe somebody else money. So when you say receivable, that means they owe you, you're going to receive it. Accounts payable means you owe them. So this one's the bad one, that's why it's a liability. This one's the good one. Receivable is the good one. Okay, and then let me say one other thing to preview, and then we'll get rolling. Most times when there is some kind of chicanery in accounting, when there's some kind of fraud, whatever you want to call it, it's going to happen on this side of the equation. One thing that a company can do to commit fraud is reduce their liabilities artificially. So just somehow say, we don't have $3 million of liabilities, we only have 1.5. And they're just, it's like smoke and mirrors with the numbers. It's not true, but they just adjust it. So it makes it look like they have less debt, more people will buy their stock. It's one way to do it. Another way they can do it is by messing with the owner's equity and just putting pluses over here that really come out of nowhere. Like, okay, well, that's great. Did you really deposit money into your account, or is that just smoke and mirrors? So what we're going to ask today is anytime you affect the owner's equity account over here, we have to further describe what happened in that. So why is there a plus or a minus there? And we have 4 choices that can happen with the owner's money. And I'm just throwing this at you right now, and then we'll break it down more slowly in a second. But the 4 choices are investment, withdrawal, revenue, and expense. Okay, so investment and revenue bring money into the company. Investment's where the owner puts money in. Revenue is where you sell something. And then the bad ones, which I put in red, are withdrawal, where the owner takes money back out of the company, or an expense where the owner has to pay something for the company. So those are 4 choices of words, and I'm going to show you how all this works as we go. So I think the easiest way to do this, like I used to do notes and PowerPoint, kind of like we did the other day. And then I'm like, it's just overwhelming. You're just writing stuff down for no reason. Isn't it a lot better to do the notes just kind of live, meaning like instead of writing down things off of PowerPoint, let's just do the problem, and then you can see where this is applied. So let's start it off. The first one should be easy. Okay, Susan Sanders invests $10,000 cash in Sanders Stitching. What's happening here is the one we've already done many times. She's starting a second bank account for her business so people can't come after her personal assets. So she just goes into the bank, moves $10,000 of her personal money over into a business account, and now the business is up and running. So remember, this chart is done from the business's perspective, and in this case, the business is receiving $10,000. So it's a plus 10,000. I'm not going to go dollar signs just to keep it a slightly more simple for us today. So plus 10,000 right there in cash. Remember the rule that if you left it like that, the brother's got 10,000 pieces of candy, the sister's upset, so we've got to balance it out. You should hopefully know this one already, but because she's investing $10,000, that means her capital or her equity in the business has gone up $10,000. So it's plus 10,000 over here. And you can see I try to do a chart today so you don't have to tab over and have all this weird spacing like that. Okay, now come over to this new column on the right. What the business world and the SEC and Franklin Delano Roosevelt ask is, it's fine to put plus $10,000 here in owner's equity. That's great. Like, that's no problem. But we want further explanation as to where that money came from. And so the further explanation is simply one of these 4 choices up here. Was that an investment, a withdrawal, a revenue, or an expense when this occurred? And in this case, you look and you say, it says it literally right there, invest. When the owner puts money into the company, it's a positive. The company's getting money, and so that's why it's one of these green words. The green words are the positive ones, and so literally all you're going to do is type investment. So in this column, you only will type it if it affects this column here, and you choose one of these four words, and that's it. So now the government can say, all right, we get it. And if we wanted proof, they could go to our bank and say, hey, he says or she says on this date she invested 10 grand. Is that true? Is that accurate? We say, yeah, there's a receipt or whatever. There's the transaction, and we're good to go. Okay, and then we go down here to new balances, and we go 10,000. And then here's kind of the tedious part, but it's a lot easier with these columns now. 0, 0, 0, and we're at 10,000. And of course, we're still in balance, and all is well with the world. Oh, perfect. All right, coming down here now. Susan buys $2,000 worth of supplies. This is not a new one either. We should be okay here. Notice it doesn't say on account or anything, so we can assume they're paying cash, that she's paying cash. So minus 2,000 in cash. And then you come over here to supplies, and we say plus 2,000 in supplies. Now, the question will come up, and this is a good question. Do I have to put anything over here in this final box, this far right box? And the answer is no. The only time you have to write a word in the box is if owner's equity, this far right column, gets affected with a plus or minus. Since in this example it's not, we need no further explanation. This is very self-explanatory. The government knows what's going on here, no problem. And so now we can just do our new balances. So only write a word if it affects owner's equity. So always check my math here. Make sure I'm just doing this off the top of my head. Make sure I'm not messing anything up with math, please. 2,000, 0, 0, and 10,000. And all is well. Spot check it. 8,000 plus 2,000 is 10,000, good. 0 plus 10,000, 10,000 is good. We're all equal. Everything's good. Spot check it on Friday when we have our quiz. All right, next one. Again, nothing new here. We're okay. She buys $500 worth of insurance. Every business has to do that early in their life. All right, so we buy $500, sorry, I'm already screwing it up. $500 worth of insurance minus 500 in cash. I know it doesn't say cash, but if it doesn't give further explanation, you can understand that you're paying cash. And then for insurance, so we go over to insurance, and remember that you're getting more insurance, plus you've got to make sure the account is balanced, the equation is balanced. And so you took 500 pieces of candy away from him, but you gave him 500 pieces of candy, and all is well. So I'm hoping that these transactions so far are pretty good. We'll get to some new ones in a moment here. 7,500, 0, 2,000, 500, 0, and 10,000. Again, I'll repeat it. I haven't had to write any words over here in this bonus section because we haven't affected owner's equity since the first transaction. That's the nice thing. You only have to worry about it if it affects the far right one, which we'll do in a moment. All right. This one I've described before, and we've done this one before too. Not totally difficult, but a little more challenging. She buys $1,000 worth of supplies on account from Maxwell Company. So when you see on account, that's your red flag. It's not cash. We're not buying anything on cash with cash. We're walking into the store with our card and saying we're going to walk out, but we'll pay you later. Okay. So what do we do here? We say we buy in supplies. Come on, double. There we go. Plus 1,000 in supplies. I think you're okay with that. And then the challenge is, okay, I know it's Maxwell Company because it says Maxwell Company, and I have a column for Maxwell Company. Remember, the challenge is that a plus or a minus? Easy, the cheating way, cheating. It's not really cheating. You understand it. Plus 1,000, you gave the brother 1,000 pieces of candy. The sister's mad. You better give her 1,000 pieces of candy or else we're out of balance. But why is it plus 1,000? Because we owed them nothing. And then after this transaction, our debt to them increased by $1,000. That's how you have to start thinking as an accountant. The debt goes up. That's why it's plus 1,000. Okay? And then we'll do our totals. 7,500, 0, 3,000 now in supplies, 500 here the first time, 1,000, okay, and then 10,000. Okay, and I feel like at this point, kind of a review. All is pretty well. The only thing we've added is that one word on the first line there where we had to say investment. Now it's from here on out where we get some new stuff. Okay, but it's not bad. You're going to be fine. All right, so we'll come down here. This is a new transaction, and this is the good transaction because we've been waiting for this one. Finally, we're going to sell something. All right, so whatever she's selling here, if somebody came in and needed something stitched, it's the $300 bill. They pay right now. So she's receiving $300 cash for a sale. Okay, when you see 300 cash, you just go plus 300 in cash. That's easy. Okay, that's the first one. That's not the challenging part. The challenging part comes now. Where does the sale go? Where is that column? I don't see anything up at the top. I'll scroll up here. There's nothing that says sale. Here's your clue on that. If there's nothing that says the exact thing we're trying to find, then it's going to go in the owner's equity column. And it's going to be one of these 4 words. Okay, that's your clue. So from a sale, and I think many of you know this from taking previous business classes or just common knowledge, is it's going to, well, let's go down here to owner's equity. First off, you know that in this column, we need to do the brother-sister rule. So it's going to be plus 300. And you don't need to understand anything about why it's plus other than you gave the brother 300 pieces of candy, you better give the sister. But also what you're asking yourself here is when you sell something, that increases the owner's money in the business. Like that's good for the owner. So, Bandito Taco, when they sell 27 tacos, that money goes to the owner. I mean, it's the owner's money at the end of the day. Now, our choices are, which of these 4 words is it? I know it's a plus, so the 2 choices now are limited to the green ones because I put those in green on purpose. Those are the ones that make it go up. It's not an investment. I think you now know that it's revenue. So anytime you sell something, and we could do this on notes, but I thought it was so much easier to just do the problem. Anytime you sell something, it's revenue. So revenue equals sales. So you may want to jot that down on the side, like on a piece of paper, so you have that when you're doing on your own here in a minute. But it's revenue. Okay, and that's a good thing. We love revenue. We want sales. Obviously, today, when Netflix reports, we want this column and the revenue numbers to be huge. That's how a stock goes up. Okay, so revenue, that's it. So plus 300 there, plus 300. Why did I have to write a word? Because I affected that far right column. And anytime you do that, you got to write a word. Okay, and then we'll carry our new balances down to the second page. So now this is where the math starts getting a little dicier. But I got 7,800 now in cash. 0, 3,000, 500. Again, please speak up if anything's going haywire here. I can't see anything. So let me know if anybody's having troubles or if the technology's not working. Just whatever might happen, let me know, please. Okay, and I'm going to spot check this off the top of my head. I got 10,800, I got 11,300, and I got 11,300. We're good. Again, I love accounting because I can stop at any point and I can check and say, okay, am I good here? Have I messed up clearly? And right now I think we're okay. All right, let's keep going down. Okay, this is the next hardest one. Maybe the hardest one of all. Okay, she's going to sell $2,000 worth, this should say of services. I'm going to add that to mine. I know it won't say it on yours, but I'm going to add that. You can add it too. Susan sells $2,000 worth of services on account to Bowman Company. Okay, so this is a little dicey. She's selling $2,000, but she's not receiving any money. This is a fine transaction, and this is kind of how the business world works, but I don't love it because I'm doing $2,000 worth of stuff. So I'm putting in a lot of hours for her stitching, or Bowman Company stitching, yet I'm not getting any money yet. They're going to owe me. Here's the order I do that one in. I see the word sells. That's my key, that it's revenue. Anytime it's selling, sales, up there it was sales, here it sells. Anytime you see that, that's the word revenue over here on the far right. So let's do that one first. So it's plus 2,000 here. in owner's equity because the owner gets that money, even though it's not there yet. That's what worries me. But the owner will get that money. And we put revenue. And so the only difference between this one and the previous one is instead of getting the money now, we're going to get it later. And it will come later, but we don't have it. Okay? All right, so where does the other one go? This is the hard part. It says Bowman Company, and I've got a column right here that we haven't touched yet, the second one over, called Bowman Company. All right, and then the only challenge, I'm going to put my cursor there so we know it's there. The challenge is plus or minus. Well, first off, brother-sister rule. This is the first time we've given the sister the candy first, giving her plus 2,000. So what is the brother doing? He's ticked. He's like, you got to give me candy. It's not fair. And we're like, all right, here you come, plus 2,000. And then accounting-wise, the explanation for that is how much do they owe you? How much did your asset increase? Bowman Company now owes us $2,000. And you better write that down because if you don't, you're going to forget that they owe you money. You know, you probably loan money to a friend sometime and slowly that you just forget about it and then eventually you never pay them. Well, that's what could happen if you don't write this down. So you got to keep good records. This is why you do accounting. Now Bowman Company owes you $2,000. And that's it. So once you affect two boxes, you're good. That one's challenging though. All right, so new balances are 7,800, 2,000, 3,000, 500, 1,000, and then 12,300. So now we have a little bit of debt. Now we're getting to like a real business. We owe somebody money. We owe them $1,000 over here in the liabilities, but we also have someone that owes us money, $2,000. You can see how this gets complicated. How a business's books get real complicated really fast because you got people owing you money. You owe people money. Man, it can get really wild, and you can see how easy it would be to kind of sneak creepy number or like cheap numbers in there and try to doctor up these to make your company look better. Okay, we're almost to the bottom here. Let me see how many we got left. We got 1, 2, 3. We got 4 left, but some new ones. And then we'll turn it over to you. Okay, Susan withdraws $200 cash from the business for her own personal use. Okay, here's one we haven't covered. At any time in a small business's life, the owner can come in and take money out of the business and put it back into their own personal account. Like that's their right. The example I always use, at Papa Murphy's. If you own the Papa Murphy's, is it okay for you to come in at 2 a.m., after everything's all closed, go into the cash register, take out some money and put it in your pocket and then, do whatever you're going to do at 2 a.m. or do whatever you're going to do the next day? Absolutely. It's your company. The only thing that you have to worry about when you do that is you've got to write it down in your chart. Because if you don't, then the accountant's going to come in and say, well, where'd that money go? Like, I don't care if you do that. I don't care if you go take it, but you got to write it down or else this money's missing, and then we got a problem. Okay, so where do we write this down when the owner takes money out? Okay, it says withdraws $200 cash, so I'm going to go minus 200 in cash. That's not hard. Okay. Then follow the rule that I said. If there's no column up at the top that says like withdrawal or anything like that, then it's going to go over here in the owner's equity. I call owner's equity kind of the potpourri category. It catches the things that you don't have a column for. And let's use the brother-sister rule to figure out the number. We took 200 pieces of candy away from the brother, so we better take 200 pieces of candy away from the sister or else we're in trouble. Why is it minus 200 there, though? Because the owner's equity, the amount that the owner has invested in the business, has just reduced by 200 because she came in and took it out. Now, her own personal pocket's great. Like she has 200 bucks. We don't care about her personal pocket. We care about how much she has invested in the business. Now, you look here. Because we're affecting it, we've got to use one of the two red words because we have a negative number. We're taking money out. And literally, it says the word withdrawal. Anytime the owner takes money out, it's like going to an ATM, in this case, going into your cash register and taking it out, and you say withdrawal. Now, there's nothing wrong with that. I feel like I cast a negative aspersion on an owner taking out money. It's absolutely their prerogative to come in and take money out. That's why you start a business. But you've got to write this down. Here's how a lot of companies have cheated. Come in and take some money out, but don't write it down. The company we're going to study later in the year, Enron, the owner came in, took out $1 million to throw his wife a birthday party on a yacht and didn't tell anybody. Just took out $1 million. One night party. And so the company was out $1 million. No one knew where that money went. I mean, it's an easy trick to do. It's nothing complicated about it. And yet that's what they did over and over, all these kind of shenanigans. And then the company went kaput because everybody found out about it. We'll talk about that. All right, new totals. 7,600, 2,000, 3,000, 500, 1,000, and 12,100. Now, as we get down here, I'm going fast, so somebody speak up if that's messed up. I got 12,300 on the right, 12,100, excuse me, 13,100. I'm screwing up right now. 80, 96, 12,6, 13,1. Okay, well, I think we're okay. All right, last three. Okay. This one we've done before, so this shouldn't be too new, but let's walk through it again. Susan pays $1,000 cash on account to Maxwell Company. So we have this Maxwell Company debt over here. We owed them $1,000, and now we probably have a deal at this point in the month that, hey, we'll pay it off now. Okay, so it says pays 1,000 cash. That's easy. So I'm going to go minus 1,000 in cash, and then do I have, this is how I determine where the other one. Do I have a column that says Maxwell Company? And I do. And my Maxwell Company is this liability over here on the right side of the equation. And again, you can get confused by the pluses and minuses, but don't. Just say if you took 1,000 away from the brother, you better take 1,000 away from the sister to keep everybody happy. Why is it minus 1,000? Because we owed them $1,000 before this transaction. Now, because we paid them 1,000 cash, we can reduce that debt, and we don't owe them anything anymore. So that's why it's a negative there. But if that's overwhelming to you, don't worry about it. Just use the brother-sister rule. Okay? And so now we're down to 6,600, 2,000 here, 3,000 here, 500 here, 0, and 12,100. And here's why I like this transaction, because now I have no liabilities. Just a quick story. Today was payday for us, for teachers. So I get up, and about 1 a.m., I always do this. It's so stupid. It's like looking at stocks. But at 1 a.m., I get up, I get out of bed, and because our bank account goes up, because our paychecks get direct deposited, I pay our bills. And the two bills I pay right away are mortgage, because that's our most expensive liability, and our car payment, which is our second one. So it would be such a good feeling if I didn't have to do that, if I didn't have liabilities. But as I told you, it's impossible. Like if you want to buy a house, if you want to buy a car, you're probably going to go into debt, and that's the debt that we pay on payday. Okay. All right, last two. All right, Susan receives $2,000 on account from Bowman Company. Okay. Now what's happening here? Bowman Company, which is the second column over, they owe us $2,000, right? And so finally, they're going to pay it. So this is a good transaction for us. We clap our hands and we say yes. All right. Now, it doesn't say cash, and it does say on account. So the one thing I want to, caution you of, I kept saying if it says on account, it doesn't say cash. When you're receiving it, though, you are getting cash in this case. They're paying off their debt to you. So that sale we made 2 weeks ago, now we're going to finally get the money for it. So in this case, it's plus 2,000 in cash. We're like, thank you for paying us. But then the other account that gets affected, you have a column for Bowman Company. It's right next to it. It's right next door. All right, and you can use the brother-sister rule, or I can also explain it in accounting. They did owe you $2,000, but because they're paying it off, they're reducing what they owe us. So it's a minus 2,000 here. The other way, though, is the brother-sister. Since we're affecting the brother with both of these, they got to cancel each other out, because the sister's over here spying on us, saying, okay, are we going to be good here? Or why is he getting 2,000? You're like, don't worry. We're going to subtract 2,000 too, and all is well. Okay? So that's a hard one, but it's not really that hard once you figure it out. It's just new to you right now. Okay? So let's do our new math here. 8,600 now, which is great. Our cash went up. What they owe us is now 0. So I like this because we're starting to what I call clean up our books, meaning now we don't owe anyone money and they don't owe us any money. And a lot of times at the end of the month, the business likes to do this. So they go into the next month clear of any debt and clear of anybody else owing them money. So that's why they call it accounts receivable or accounts payable. That means either someone owes you money or you owe them money. All right, and then the last one. This is a new one. Of course, any business will have to pay for the upkeep of the business, meaning electricity, rent, water bills, cell phone bills, any of those things. So those are all called expenses, just random things that you have to pay. This morning I paid our cell phone bill again because it was payday. I always wait till payday to start paying. This morning I did that. Okay. So what do we do here? Susan pays 400 bucks. Well, first off, let's go minus 400 in cash. Okay? That's easy. The hard part on this one is there's nothing up at the top that says, let me move my picture here, that says electric bill. Okay, so I go up to the top and nothing that says electric bill. I have nothing there that would satisfy that. So what the heck do I do? Remember, the rule is if you don't have anything that says it, owner's equity is the place to put it. Okay, so let's put it in owner's equity and let's talk about it. First off, brother-sister rule. If it was minus 400 on the brother side, it better be minus 400 on the sister side. That's why I love accounting. Like, that rule never changes. You can't really mess that up. All right. Then we say, okay, it's minus 400. If we just left that alone, the SEC would say, okay, great, minus 400. I don't mind you doing that, but you got to explain that further. And our four choices up here, and I think you probably already know this, but our four choices up here are investment, withdrawal, revenue, expense. Well, first off, I know it's a minus, so I'm going to use one of the two in red. It's either going to be a withdrawal or an expense. And a withdrawal means when the owner takes their money out for personal use, which is not happening here. Like, they're not benefiting from this. They just have to pay something. And so that's going to be an expense. So anytime it's something random, like I said, a rent, a cell phone, electricity bill, anything that you think would qualify as what we call an expense, then it's an expense. We write that there. So again, to reiterate, the only time you have to write words are when we affect the far right box. If you don't affect it, you don't have to put a word over there. Okay, and that's it. So $400 for their electric bill on the last day, whatever that is. Okay, and then let's go final balances. And this is the moment of truth, and this is what I'm going to have you guys send me on the chat on your other problem, is you're going to send me these last numbers, and I'm going to say yep or nope, those aren't right. 3,500. 0, and then let's see here, 12,100, so I got 11,700. Okay, and then what I always do at the end, I don't have the question at the bottom. I didn't put like, do they all equal in red, but I go 8,200 plus 3,000 is 11,200 plus 500 is 11,700. Come over here, 0 plus 11,700 is 11,700, and I feel so good. Like, if we have a quiz on Friday, you get down to the bottom, and you're like, yes, that worked out. You know, I've been doing these. I wrote the problem, and then I did it over the weekend, and I got to the bottom, and it wasn't right. And what I had done is a math error, like on step 5 up above, and I'm like, dang it, that's so stupid. But just be careful. It's not necessarily that you're doing the problem wrong. It's that you maybe added or subtracted something wrong, or you saw the sign wrong, whatever. But once you get down here, you're good to go. Okay? So that's how this problem works. What I want you to do right now, I'll give you a second, kind of take a pause here, is I want you to submit that one. So hopefully you got all that done. Let me know if you need any help on that. I'm going to stop our recording, and then we'll move on to the one. I'll turn it over to you so you can work at your own pace in just a second. But go ahead and take a second to submit that.